My name's Chuck Jaffe. I am the host of a 1 hour daily podcast called Money Life, and I'm also the host of the Navigator podcast for the Active Investment Company Alliance. This session is Trends and Outlooks for BDCs, the view from a regulator, an industry advocate, and counsel. Now, a small housekeeping note as we get to the end. I'm going to be hopeful that we could open the floor up for questions and answers. But if you have a question, you're dying to make sure we get to it, etc., feel free to write it down and pass notes up to me or do whatever you can. I'll be happy to take. Now, when I get asked to put together a panel discussion, I like to go in one of two different directions. Either we have people where we take a process and we have different players looking at how the issues are playing out. We kind of walk from one panelist to the next. Everybody gets kind of one shot at it. Or we set up what amounts to the good, the bad, and the ugly, right? Just have those three kind of groups and you put them together. So John Colescott knows this because I've done panels here before. And when he asked me to moderate this panel, he said, I set it up just the way you like it. And I said, what is it? And he sends me the title and it says, you got a regulator, you got a lobbyist, and you got a lawyer. And I said, a regulator, a lobbyist, and a lawyer, that's either for most people, the bad, and the bad, or the ugly, and the ugly. But we're going to try to make it good, and good. That's my plan here as we dig into the advocacy process. Let me introduce my panel in order of the session's title while encouraging you to learn more than just their titles by reading the details and the definitions that they left for you in all of the materials for the program. So joining me on the stage, the regulator is Kaitlin Bottock. She is assistant director at the SEC. The industry advocate, because some people think lobbyist is a bad word, so we will call industry advocate because that's what she is Tonnie Wybensinger. She's head of government relations for the SBIA, the Small Business Investor Alliance. And then counsel is Kenneth Burdon, partner at Simpson, Thacher, and Bartlett. I'm going to start our discussion with Tonnie. And I'm going to do that, which, by the way, automatically means they all are going, well, we're off script already. True, we are. But I decided to do it because her job is maybe the most proactive. If you are advocating, you are taking a very strong position as opposed to, in some ways, muting positions or weighing positions. And it's also the job that's least understood by the public. So, Tonnie, we start tight on time, and I don't want to use much of it on background stuff. But can you explain the role you play as an industry advocate and what is important that BDCs themselves, and why it is important that BDCs themselves are getting involved in advocacy organizations, why BDC investors want to know about ongoing advocacy efforts?
Sure. So it's important, our president at SBIA always says, if you're not at the table, you're on the menu. And so we just make sure that Congress, policymakers, regulators often understand the issues that you all have. So legislative issues, regulatory issues, you need someone in the room. And, I'm in Washington, D.C., and I have direct access to them on a regular basis, which you probably have more access to them than you think. But, you need a spokesperson who knows them, who knows their staff, and are able to go in and explain, AFFE is an issue, there's tax issues. And so it just gives the BDC industry an opportunity to have someone there day to day when you guys have your own day jobs.
Is it also, as I think most of us would suspect, that basically there is not a member of Congress who is sitting in their office with all the things they have to weigh, who goes, oh, and we're putting together this tax proposal. Let's make sure we cover the BDC industry, that there's so much that goes into this in a 1,000-page bill in some cases, like we're dealing with now, that if no advocacy is literally out of sight, completely out of mind.
Right. Like I said, or like you said, they deal with issues, foreign policy issues. I would say, horse slaughter act, they're dealing with issues all the time. And so if someone doesn't go into their office and say, BDCs have a tax issue, a 199 cap A issue, it wouldn't be in the House version of the reconciliation bill, which it is. We actually have bipartisan support for a lot of our legislative initiatives for BDCs. But when I first started at SBIA, I went into their offices and they're like, what? We've never heard of business development companies. And so we had to do a long education process process, and it's continuous education process, because as Congress turns over, and committees change, we have to go back in and make sure that they know why it's important that these bills get passed, and it's important that they have some champion, because every piece of legislation needs a champion, or it will just get it won't be thought of.
As we did our prep for this panel, we seem to agree that there are 3-4 big issues that the BDC space is looking at right now that could change the landscape in a variety of ways. They are the new model for the co-investment applications, tax parity for BDCs, 199A, and my favorite, because it's the only thing ever that rhymes with my last name, Jaffe, is AFFE, right? Which, and now, and by the way, that's acquired fund fees and expenses. And what I found interesting as we were prepping was that each of you kind of gravitated towards one, and then we're happy to be on another. So we're going to try to run through them. I won't confess to be the expert here because I've got experts on my panel, but I believe the one we're closest to seeing come to fruition is the co-investment transactions, because I saw something in early April on the SEC indicating intent to grant Franklin Square's exemptive relief to allow co-investment transactions under a new simplified principles-based framework. I'm all out of jargon, Kaitlin. That's as much as I got for you. So can you help us out, explain what that means and how co-investment's going to shake things up and where we are in the process?
Sure. Thanks, Chuck. First, let me give my very exciting disclaimer. The views I express today are made in my official capacity as a staff member of the Commission's Division of Investment Management, but do not necessarily reflect the views of the Commission, the commissioners, or other members of the staff. So co-invest. I assume a lot of you here are familiar with co-invest. The Commission and the staff has routinely provided exemptive relief over the last several decades to allow regulated funds, which include primarily BDCs, as well as closed-end funds and interval funds, to co-invest among themselves with private funds that are managed by that regulated funds advisor and with other affiliates. As I think a lot of you know, co-investment programs bring a lot of benefits to BDCs. It brings greater deal flow, better investment opportunities, the ability to participate in a wider range of opportunities, and then also potentially more favorable deal terms. Over the last several decades, the staff has gotten more and more familiar and more experienced with co-investment programs. But there have been some really key trends, I would say, over the last 10 years, and I would categorize them as more, right? So maybe in the last 10 years, what we've seen is more co-invests. I think, initially we were issuing 5 co-investment orders a year. Last year we issued over 30, right? So more. We're seeing more applicants. Typically, right, traditionally, a co-investment application might have 20, 25 applicants. Lately, we're seeing applications with hundreds, like upwards of 300 applicants that exist today, right? And of course, you can have more in the future. And then just more complexity, more complication, more types of entities want to participate in co-invests. And so it really drove the staff, I would say, in 2017 to really take a step back and start thinking about the applications that we're working on, the conditions that we require as part of this relief. And think about, is this really best serving the funds that we're seeking to protect with the conditions? And at the same time, FS filed an application, I think it was 2017, 2018, that kind of was thinking about it in the same way. And so, if you look back to that time, there's some amendments, which you can presume that the staff and FS were talking about what would be appropriate in the context of this kind of streamlined approach. At that time, the staff didn't have the authority to go forward with the application and issue a notice and order, but we did in the spring this year. So FS got its order in April. Since then, I think we've received, it's either at 70 or just over 70 applications for the same kind of relief. I'm sure some of those applications represent shops that are here today. And since then, we've also issued so far 30 orders, and we're on our way, to tackle those 70 applications, probably more by the end of the year.
Ken, more applications, more orders means more work for Council. Your take on how that's playing out?
Yes, it does. And I mean, I guess I'll give a few thoughts on the new co-investment relief. I think it's great and achieves some goals. I just want to like put a little like thematic, umbrella on this, because I think it kind of touches on each thing that we're going to talk about here. But right, so like BDCs, well, I guess let me take a further step back. We have an administration that is focused on getting capital to American businesses, right? And BDCs are the perfect investment vehicle to do that, because as I think everyone here knows, you have to have 70% of your assets in U.S. businesses, and not just big U.S. businesses, but really small U.S. businesses. BDCs as a vehicle to move capital from the investing public, like to those U.S. businesses, I think is an important theme here, and I think is an important way to frame a lot of what's going on, and like how to get what the industry would like to see for the BDC structure. So one prong of that, of course, is the co-investment order, right? And what the co-investment order does is, it allows managers with many different pools of capital to use those many different pools of capital to provide more of that capital to U.S. businesses in a way that benefits those U.S. businesses, right? So when you can pool the capital and co-invest, you can get better deals. Now, kind of how does the co-investment order do that, right? The first thing is that it allows more affiliates to participate in these co-investments. So one, more pools of capital. Like two, it kind of removed what in my view was artificial barriers to, the regulated funds, the BDCs, investing, co-investing with those other pools of capital, right? So, prior co-investment order, if any affiliate had an interest, no matter how small, in an issuer, it couldn't then subsequently do like a follow-on investment with its affiliates in that issuer. So that flat prohibition is gone now, right? You still need to go to the board, make sure that we've got, kind of appropriate oversight and approval of those types of potentially conflicted transactions. But what it does is it opens up a whole nother set of investment opportunities to the BDCs that weren't there to begin with. That's good for BDC investors, and it's good for the businesses they invest in.
Can I just add that, that's a great example of one place where I think the staff learned a lot from working with applicants over the years, and then also seeing kind of where the trends were going, right? Like I was talking about more complexity, right? Like as folks are launching more and more funds, right? Like we heard from plenty of people, this is a real barrier and it's not doing any good, right? You're not doing anything extra for the regulated fund, the BDC in that case. So like, can you, what can you do? Like, can we talk about this, right? And this came out of many conversations over many years with the staff. But I think it was a great example, too, of times when the staff hears what's coming out of the industry, partners with the industry, and we can move things forward together.
Tonnie, you were reaching, so before I move us to the next one, have you got something to add?
I just wanted to add, if you're ever talking to regulators or policymakers, that this is a back of the envelope calculation, but the 70% that's required, we calculated it, and it's more like 95% investments in just U.S. companies. So just for the future.
Yeah, which is great, right? Because I mean, you have a statutory limit, right? And most of us don't want to manage exactly to the statutory limit, right? So, even though that limit's 70%, you've got strong incentives to just invest in U.S. businesses, which is what
it's great for this administration. Great talking point for this administration.
So now we're going to move to the next issue, which is tax parity for BDCs. Back in 2017, the government gave a tax benefit to REITs that it did not extend to BDCs. So now there's a tax parity issue about leveling the playing field, which I know as somebody who talks to retail investors could make BDCs more attractive to retail investors. So Tonnie, let's talk about the effort to try to get tax parity and where things stand.
Sure. So, like you said, in 2017, the 2017 tax cuts, there was a House version, and this is where it's important that the BDC industry gets involved in organizations like SBIA. So I asked our members, take a look at the House version of this bill. Is there anything that worries you about BDCs? And they're like, no, nothing changes, so we're all good. Well, last minute in the Senate, there's a president that does care about REITs in real estate. So REITs were added to a 20% pass-through deduction for qualified business income, REIT investors, S-Corp bank investors, and publicly traded partnerships. And we were like, whoa, where are BDCs? And so we went to Congress, but it was already a delicately negotiated package, and it had to have a score, and they were like, sorry, there's no time. So when we went to the offices, they were like, oops, yeah, you guys should have been included. And it was just an oversight. I've never heard a policy objection to it. And so we have spent the last, I don't know, how long is, like 8 years? 8 years educating members of Congress, getting champions to make sure they understand that BDCs are helping grow U.S. companies. And so we've been able to get bipartisan support. And actually, we didn't need it this Congress because they don't need any Democrats to vote for this tax package. But so they went to bat for us, and the 20% pass-through deduction is in the House version of the reconciliation bill. And it does have a pretty big cost associated. I say cost because I don't know that they calculate the cost properly, because I think it'll create a lot of jobs and be helpful for shareholders. So we are working with the Senate. We should know actually by Friday whether we were able to keep it in the Senate version of the bill. And once that happens, I think we're good to go. And once it gets signed into law, your shareholders will get that. Oh, actually, they increased it to 23% deduction. So hopefully on Friday, I'll be able to send out good news.
Yeah, and is it 23%? When you do the math, becomes like effective at 28 or something. I was reading some math in there that was, I don't know.
Good question.
I'm not the math guy. Ken, you want to follow up on that?
Well, I mean, I don't have a lot to say about the tax. Unfortunately, I'm not a tax lawyer, but I do think that the idea of kind of having rational policies to apply to similar types of entities is something that we should be focused on. And so you gave an example on tax, right? Another example is, so I'm going to move away a little bit from the, listed BDCs and talk a little bit about the unlisted BDCs, right? So, what
will apply to them as well, just FYI.
Oh, yeah, the tax, right? Yeah. But, kind of another regulatory thing that's happened is, the unlisted privately offered BDCs can now issue multiple classes of shares because there's an exemptive application process. So step back. BDCs, like closed-end funds, aren't allowed to issue multiple classes of shares unless they have exemptive relief from the SEC. There's a pretty common form of that, but it never covered privately offered BDCs. The staff has started, or the commission has started granting that now. I'll let Kaitlin talk a little bit about that if she'd like, but it's pretty straightforward. So now privately offered BDCs can issue multiple classes of shares, right? So what does that do? Again, it helps the distribution of the product and helps to, again, move capital from the investing public to U.S. small businesses. Now, the other thing that does too is, so a quirk of BDCs is that they themselves don't get the exemption from state regulation, right? Blue sky laws, which is like a 4-letter word to us. But, in order for a BDC to be, have the state law regulation exemption, it either has to be privately offered or it needs to be listed. So you've got this whole, kind of group of BDCs, which are the publicly offered unlisted BDCs that have to go to the state regulators and get their offering cleared with 50 states, right? Because that's the only way you're going to get distributed. And like, let me tell you, that is an incredible process, and it gives opportunities, for individual states to kind of impose their views on the national market for BDCs, right? Which, coming back to let's treat things that are the same, right? There's no difference between an unlisted BDC, right, and a mutual fund from that perspective, right? So, I mean, mutual funds are not listed either, but they get a exemption from state regulation because they're registered investment companies and BDCs aren't. Right. So kind of one other thing, kind of trends looking forward, things to think about. How do we fix something like that? Like that's another thing to think about how to fix. Like, how do we get the BDCs, which are a national market and subject to extensive regulation of the Investment Company Act, kind of like out from under the thumb of the state regulators and the blue sky laws, which, impose a lot of costs, creates a lot of first mover advantage. Because, to get to market, to get through the state regulation process is a very long time.
There's a legislative initiative that was just introduced, I think, this week or last week to fix this issue. So it's Rep. Downing. If you want to take a look, I can send it to you. But so we're trying to move that as well. But it's too late to get it in any sort of reconciliation package. But I think there'll be some sort of cap formation package moving forward.
I want to correct one thing that Ken said. He started his remarks saying, unfortunately, I'm not a tax lawyer. There's nothing unfortunate about that. And I would ask Kaitlin to weigh in on that last one, but that disclaimer that she read, what that said in plain English was, I'm not talking active legislation that's not a regulatory case.
Yeah. I tend to stay away from active legislation as a member or as a staff member of an executive agency.
So let's.
But you are helpful in
Just a little bit
behind the scenes. You want to talk about how you...
Yeah. So I mean, my group, my office in IM, I'd like to think of as we are experts. We like to think of ourselves as subject matter experts, and so you'll see us. You'll interact with us directly when you're asking for an exemption. Sometimes we're kind of behind the scenes. Maybe we're not first desk, but we're in the background. If you have a disclosure review issue, if you have an exams issue, we might still be there. But actually, legislation is one of those areas where we do sometimes get involved. We are called upon to provide technical assistance on bills by the Hill. But again, we're in the background. It's not something that you're going to see. But, from time to time, we are asked.
So let's move this to AFFE, because that is an area where I believe you can talk about what's going on. At least a little bit, yes?
Well, I think Tonnie wanted to take AFFE. Oh, well, I mean,
You're the regulator. Go ahead. And I can talk about what's happening.
Sure.
Unless you.
Sure. So when the commission proposed the fund of funds rule, I think a lot of you know, right, there was a comment in there about AFFE, about acquired fund fees and expenses, because in 2007, the commission had required funds to disclose as a line item in their fee table and their registration statements the fees that they're paying on underlying investments in other funds, including BDCs. So they asked about AFFE. Unfortunately for the BDC community, again, without kind of taking a position, the commission chose not to take action on that when it adopted the rule in 2020. But it remains, as I understand, right, a big issue for the industry, and we do hear about it from time to time.
Yeah, so I'll jump in. So once again, REITs are carved out of having to comply with AFFE, and my theory as a industry advocate is that when that rule was passed, I think there was 8 to 10 BDCs at the time. And, I always say REITs have a city block in D.C., just to lobby Congress. And so I think that at the time, the industry maybe wasn't sophisticated enough in dealing with DC to go in and explain like why they should not have to comply, because our message to Capitol Hill is you're putting out inaccurate disclosure, since all the operating costs and management fees are already wrapped up into the NAV. And so it's been, I think we've done a good job of, it's a pretty weedy issue when you're talking to young staff to get them to understand, but we have legislation that has now passed the House committee this year, and it was supported unanimously, which last Congress, it was more of an issue. They wanted to continue to add DEI, additional DEI reporting to it, and the Republicans were like, no, and Democrats were like, well, we're not going to support it. Well, this year, I think because of the Trump executive order, they supported it, and it should be on the House floor to be voted on, and I expect it to get a unanimous vote, and so that should pass out of the House in a couple of weeks. We have a bipartisan Senate version, and we are hoping that since it's non-controversial in the House, we can hopefully move it to the Senate pretty quickly, and then Kaitlin has to implement it.
But I'm probably not the best person to speak about this, so I'm going to pass this water balloon to the two of you. But I mean, this is really an issue, right? Because the indices dropped. BDC, right?
Important. That's an important part. Why this is a big deal is, it's inaccurate disclosure. So Vanguard has to inaccurately disclose to their shareholders BDC investments. If you look at the prospectus, there's a line in the bottom that says this is not actually borne by the shareholders, the fees, but they still have to, put them in the prospectus. And so in 2012, the industry had grown from 2006 to 2012, and we're like, this is going to be a huge problem. And I'm not bashing the SEC. They were like, well, it's not a problem now. So, and then in 2012, the BDCs were dropped from the indices because institutional investment went way down, because the acquiring funds were like, well, we don't want to give inaccurate disclosure to our shareholders. So hopefully once we get that fixed, we'll be able to get the BDCs back on the indexes. However, they won't take a position until it's done, and so they could decide at the end of the day, we spent all this time getting, this AFFE fixed, but they can decide at the end of the day whether they put BDCs back on the indices. So it's a two-step process, a legislative process, and then after that, we'll have to push the indices and, lobby the indices to put them back on.
And I will simply point out as a journalist that every now and again, I wind up seeing somebody who probably shouldn't be writing about things as esoteric in the investment world as BDCs, who comes out with a piece that's talking about just how bad the expenses are. Do you understand what you're doing? And it's like, yeah, no, you, the guy who's giving the advice, like, here's a piece that is basically misleading because you're reading that chart and not reading the fine print that says this is not what the effect is, that you haven't recognized that it's basically a fund of funds and it's a layer of fees that shouldn't properly be counted. So
and we did not commission this study. I think the Capitol Hill it was suspicious of it at first, but Temple University, if anyone emails me, I'm happy to send it to them, did a study, some nerds who were getting their PhD, and there is they found out that AFFE really does hurt Main Street investment because of the liquidity. There's less liquidity because institutional investment has dropped. So,
by the way, on behalf of the nerds, like lobbyists want to be called advocacy.
I'm a nerd too.
They're just smart people or something. There's got to be another word. We haven't figured it out yet. Let's move this. We've touched on it a little bit, but I don't think we wrapped up where we should be on 199A. So let's try to make sure we include that.
That's the tax parity issue.
So, but did we get through everything? I mean, obviously we understand that this is part of one big, beautiful bill and it's going to wind up going there, but we do have the bipartisan support. Everything is there that this hopefully carries. Hopefully carries.
The score of it, the the CBO, Congressional Budget Office, has to decide what the impact is to the bill. I was very pleased that we were able to get it in because we got it back, and it was the 20% pass-through deduction, and it scored at $9 billion. And as you know, the package, a lot of conservatives and, well, I guess both sides of the aisle are worried about the cost of it. When it went up to 23%, now it scores at $11 billion. So we're just making sure that we have the House sponsors, talking to the Senate and letting them know this is important to them to keep it in. And we have some champions in the Senate that are hopefully, if there's any issues, we'll make the case for America First type case, so that this is U.S. businesses, smaller businesses. So this will be impactful. The more shareholders, the more investments in small businesses.
So we're going to open this up to questions on the floor, but before we do that, I'll ask my last one so you can prep yours. I have more if it won't be my last if you don't have any. But we talked about the pressing legislative issues. If we were to reconvene this panel 1 year from now, say, okay, went so well, hopefully, that everybody wants to hear us talk again, what's the issue that you are looking at that didn't come up today that you think would be on the burner for next year? So this is the one that's on the horizon. I need you to take your longest view or what it is to give me an idea. And by the way, they are not prepared for this question at all. But that's kind of what we want. So we'll start here.
I think there's an opportunity, especially those BDCs that invest in more venture-related companies. Right now, they will invest in a smaller tech company. It will grow. They'll get it to the $250 million cap, and then they would like to do a follow-on investment, and they're not able to do it because it hits that cap. So I think we would, in the future, if all of this goes well, use that as a priority, at least maybe discussing it with the regulators, or if we have to do any sort of legislative fix, we would focus on that.
Okay. Ken?
I do like that. I do, well, and I will have my own, but I do like BDCs are predominantly private credit vehicles. I think they were predominantly envisioned as venture capital vehicles. So using the structure to do that would be quite interesting again.
I don't think it's ever been adjusted for inflation. So obviously that makes a big difference. There's a lot of issues that we're working on at SBIA to get things adjusted for inflation.
But so I'm going to have to go back to the non-listeds again, but it's figuring out a reasonable way to use what we call 506C. So that's private offerings with general solicitation, right? So, again, this kind of half goes to the issue that we were talking about, needing to have a private offering to, not have state blue sky regulation. Well, kind of part of the issue too is like being able to, solicit your investors, even if, they have to have an accredited investor standard. And what 506C does is it allows you to do general solicitations and private offerings. But, kind of the process in terms of verifying accredited status, just it isn't really workable, from a scaled, kind of point of view. Some people do it, but it's not widespread. There has been some helpful movement on that. But, kind of in terms of, retail, right? We're still talking an AI standard, BDCs. People aren't, dropping $250,000 tickets, right? So those are, kind of moving forward that, could be a good thing to see where we're at in a year.
I'm going to say the new chairman's agenda. We'll probably be talking a lot about that, right? We have a still relatively new chairman, Chairman Paul Atkins, who arrived with us in close to the end of April, right? We're still waiting, I think, both as a staff and an industry to see kind of where his commission is going to head. And I'd like to think that in a year, not only will we know, but we'll be, some steps into it. And so we'll probably be talking a lot about that.
I like it. So we can plan on that. We've planned on Q&A. If you've got questions, now's your time. Please let me know. So right there, and please when you give your questions, say who you are so everybody knows.
I fill out Trinity Capital for a BDC. Question for Tonnie is how can we as managers support you in your work?
Before you answer, I'm just going to repeat it so we get it on tape. The question was, how can BDC managers support industry advocates in their work?
Yeah. Well, Ben's a superstar SBIA member, so always emailing, asking how he can help. I think that people who don't live in D.C. think their members of Congress aren't as accessible as they are. And so Ben, for example, reached out to Senator Gallego of Arizona and talked to his staff or maybe the senator directly. And that senator is now one of the original co-sponsors of the Senate AFFE legislation. You know, it makes a big difference when your members of Congress hear from you or hear directly from the industry instead of just they probably get a little tired of hearing from me. So I think just if an issue is important to you, reaching out to your member, letting them know that, it's huge. And I think one of the most important things from you all is anecdotes. And so how is this impacting small businesses? Who are you invested in and their district? Because, you know, if it's just theoretical, they're not necessarily as interested if you, you know, talk about a specific business or if you're located in their state or district. They want it to be some sort of connection to home instead of just helping so-called Wall Street. And Ben has been awesome. Thank you, Ben.
Other questions? Okay, well, I'll use some more of our time then since we have it. In my role, I spend a lot of time dealing with consumers. And with BDCs, dealing so much in private credit and the expansion in private credit, I have individual investors who are savvy enough to be investing in BDCs, but the one thing they worry about is will we have at some point the blow up that seems to happen inevitably in any new or emerging asset class that gains popularity. So they're worried about private credit, how it gets valued. We have a problem at some point and something winds up blowing up. I'm not going to ask whether you think that's likely. I will point out that virtually everyone in the industry says it is unlikely. That doesn't stop the public from worrying. But I will ask this question. How would a black eye for the BDC industry, if we have some sort of a blow up in private credit, et cetera, how would that impact you guys and your efforts and what we're trying to get done?
So I'll go first. You know, I think there's the black eye that you talked about, right? There's also the black eye of, you know, if there's like a regulatory blow up too, you know, some of the structures that kind of underpin, you know, what BDCs do if somebody gets it wrong, and they're subject to a enforcement action, right? That's going to tamp down on things as well. You know, I think in the end, like, you have to explain kind of what the issue is to folks, and explain why it arose and kind of understand and come back out to, you know, kind of say, you know, this is how we've solved it. And we're going to be able to kind of move forward, whether it's kind of a better business practice or whether it's, you know, through kind of a different set of regulation to kind of, you know, reset, you know, confidence. But I also think that kind of, you know, outside of like a big, you know, kind of market black eye, right? I mean, you know, the demand for private credit is just kind of insatiable, right? And, you know, in terms of just retailization of private markets, you know, I think what I commonly hear is, you know, we've kind of got people maybe kind of 1% allocated to alternatives, and, you know, people want to see up to 10% allocated to alternatives. So, right, there's a big gap to fill. And I think that kind of the industry, if there's a black eye, would continue to innovate and assuage those concerns because, you know, kind of overall, as you move kind of forward and look forward, I think, you can recover from something like that. And we've seen that happen in the past.
I'll take this in a little bit of a different direction and just say, obviously you see the regulators right after, I'll just use the term black eye because that's what we're using, right? You see us react. But I think you're also seeing us spend more and more time investing in kind of learning ahead of time and trying to be best positioned for whenever and wherever the next black eye comes, right? And, sometimes it just comes and we can't do that, right? I mean, I would point to the Russian invasion of Ukraine and the effect on, Russian-focused ETFs as something that, I didn't personally see coming. But, we're trying to spend more and more time kind of getting ahead of those things. Obviously, we had our third Emerging Trends conference last week, right? And we're trying to publicly do so and engage in those conversations for the benefit of the public and investors, too.
It would not be good for legislative initiatives. Right now, we're able to talk about how getting the leverage legislation passed made the industry a bit safer because if they go over the one to one, they have some breathing room, and we think that during COVID that was helpful in making sure all the BDCs got through it. And if there is some sort of black eye, it would be hard to go to Congress and say these are good for retail investors, aka retirees, if that's a problem.
Folks, we've come to the end of our time. I think John Cole Scott was proven right. It wasn't good, bad, and ugly. It was good, good, and good. I'd like to thank Kaitlin Bottock, Kenneth Burdon, and Tonnie Wybensinger. And I'd like to thank you for being a great audience. Thank you so much. Enjoy the rest of your day.